Imagine Wall Street in the mid-19th century. It wasn't the lightning-fast digital arena we know today. Instead, it was a cacophony of shouting men, hand signals, and desperate runners. Information traveled at the speed of a human leg or a whispered secret. For investors and brokers, getting the latest stock price was a literal race against time, a mad dash for advantage in an opaque, often chaotic market. This was a world ripe for disruption, a financial landscape constrained by the very slowness of its communication. Before the ticker, market information was a precious, perishable commodity. Brokers hired young men, known as pad shovers or board boys, to sprint between the exchange floor and their offices, scribbling down prices on slips of paper. Inside brokerage houses, clerks laboriously updated massive chalkboards. Any significant market shift, a sudden surge or a dramatic plunge, would take minutes, sometimes even longer, to propagate through the financial district. This delay wasn't just inconvenient. It was an open invitation for manipulation and insider advantage. In this environment, the true power players were those with the fastest lines of communication, often through private telegraph wires or privileged access to exchange information. A few seconds head start on a major price movement could mean fortunes made or lost. The system was inherently unfair, rewarding proximity and connections over analysis or genuine insight. The vast majority of investors operated in a fog, making decisions based on stale data, constantly behind the curve and vulnerable to those in the know. The market craved real-time transparency. The seeds of change were sown not by a financier, but by an unlikely inventor named Edward Calahan. Working as a telegrapher in New York City, Calahan understood the immense potential of electrical signals to transmit information rapidly. He witnessed firsthand the inefficiencies of Wall Street's manual data delivery. His vision was simple yet revolutionary. What if a telegraph could not only send messages, but also print them out automatically, directly into the offices of brokers and investors? This was the genesis of a device that would forever alter finance. Calahan's inspiration came from existing telegraph printings, machines designed for journalists or specialized communication. But he envisioned one specifically adapted for the frantic pace of stock market data. His design had to be robust, easy to operate, and crucially, able to print characters onto a continuous paper strip. In 1867, Calahan debuted his prototype, a clunky but functional marvel that could receive market quotes transmitted by telegrapher operators and mechanically emboss them onto a narrow ribbon of paper. It was far from perfect, but it worked. The early ticker machine was an ingenious piece of clockwork and electrical engineering. It used two synchronous rotating type wheels, one for numbers, one for letters. When a telegraph operator at the stock exchange sent an electrical pulse, it would momentarily stop the wheels at the correct character, which would then be pressed onto a thin paper strip, the tape. This continuous ribbon, bearing company symbols and prices, would then feed out of the machine, delivering market data directly to the subscriber's office, a true marvel of its era. Despite its revolutionary promise, Calahan's initial ticker faced significant hurdles. The machines were temperamental, prone to jamming, and required constant synchronization. A single hiccup could throw an entire network of tickers out of sync, leading to errors and frantic repairs. Furthermore, the speed was still limited by the manual input of the telegraph operator and the mechanical constraints of the printer. While a vast improvement over messengers, the technology needed refinement to truly handle the sheer volume and speed demanded by Wall Street. Enter a young, ambitious inventor named Thomas Edison. By the late 1860s, Edison was already making a name for himself in telegraphy, having developed several improvements to existing systems. He saw the potential in Calahan's ticker, but also recognized its glaring limitations. Edison, with his relentless drive for practical innovation, believed he could build a better, more reliable, and significantly faster machine. His journey into finance was driven not by market speculation, but by an inventor's quest to solve a complex engineering problem. Edison's breakthrough came with his universal stock ticker, which he patented in 1870. Unlike Calahan's system, Edison's design greatly simplified the printing mechanism, making it far more robust and less prone to errors. Crucially, it also synchronized all the tickers on a network automatically, eliminating the frustrating problem of machines falling out of alignment. His ingenuity lay in creating a system that was not just faster, but also scalable and reliable enough to serve a rapidly expanding financial market. This was the moment the ticker truly came into its own. One of Edison's key innovations was the use of a single type wheel with both letters and numbers, controlled by a highly accurate electromagnetic system.
This eliminated the need for two separate wheels and their complex synchronization. His design also featured a simpler paper feed mechanism and a more efficient way to receive and decode telegraphic signals. The result was a ticker that could print at speeds unheard of before, transforming raw electrical impulses into legible, real-time market data directly in subscribers' offices with unprecedented accuracy and dependability.
The market's reaction was immediate and overwhelmingly positive. Brokers, exasperated by the unreliability of earlier systems, flocked to acquire Edison's universal ticker. The Western Union Telegraph Company quickly recognized the immense value and bought Edison's ticker rights for a staggering $40,000, a princely sum in 1870. This sale and the subsequent formation of the Gold and Stock Telegraph Company solidified the ticker's place as an indispensable tool, kickstarting its widespread adoption across Wall Street and beyond. The age of instant market data had truly begun. Within a few years, ticker machines became ubiquitous across the financial district. They whirred and clicked in thousands of brokerage offices, bank branches, and even the private studies of wealthy investors. The iconic clatter of the ticker tape machine became the very soundtrack of Wall Street, symbolizing its relentless pace and constant pulse. For the first time, financial information was flowing not just between the exchange and a select few, but into a broad network of subscribers, profoundly decentralizing access to critical market data. The sound of the ticker tape machine, a rhythmic clicking and whirring, became synonymous with the heartbeat of American capitalism. It was the sound of money being made and lost, of fortunes shifting with every character printed. Traders developed an almost symbiotic relationship with their tickers, listening for nuances in the rhythm, a pause or a sudden burst of activity that might signal an important development. This auditory landscape solidified the ticker's emotional and practical grip on the financial world, making it an indispensable part of daily operations. The newfound speed of information radically changed trading strategies. Before, larger, slower movements were the norm. Now, with prices updated every few seconds, the opportunity for rapid-fire speculation exploded. Day trading, buying and selling within the same day to profit from small price fluctuations, became a viable strategy for the first time. The ticker allowed traders to react almost instantly to news, rumors, and shifting market sentiment, turning Wall Street into an even more dynamic and often more volatile arena of high-stakes gambling and quick profits. For the first time, individuals outside the inner circle of Wall Street could, in theory, follow the market in near real time. Public ticker rooms opened, allowing anyone with a few cents to watch the tape. This democratization of information, though still limited by cost and access, profoundly impacted public perception of the stock market. It transformed it from a distant, arcane institution into something more immediate and understandable, drawing in a new generation of small-time investors eager to participate in the nation's burgeoning economic growth. The ticker tape also created entirely new job categories and specialized roles within the financial industry. Tape boys were employed to collect and organize the endless streams of paper tape, ensuring quotes were legible and readily available. More significantly, tape readers emerged, experts who could rapidly interpret the symbols and numbers, often identifying trends or anomalies faster than the average observer. These roles underscored the growing complexity of market information and the need for human expertise to process and leverage its immense volume and speed. The physical landscape of Wall Street itself began to transform. Brokerage offices expanded to accommodate more ticker machines and the bustling activity they generated. New buildings rose, designed to house the growing infrastructure of telegraph lines, pneumatic tubes, and busy trading floors. The ticker tape, in essence, became the nervous system of the financial district, driving its growth, dictating its pace, and shaping its architectural evolution as companies sought to maximize their access to this vital information flow. It made Wall Street a truly integrated entity. The psychological impact on traders was profound. The constant rhythmic flow of information created an atmosphere of heightened tension and immediate gratification. Decisions had to be made in seconds, not minutes, often based on interpreting symbols and numbers flashing by. This relentless pace bred a new breed of trader, sharp, quick-witted, and constantly on edge. The ticker tape became a direct conduit for the market's collective anxiety and excitement, shaping the emotional intensity that would forever define the Wall Street experience. It was an addiction. While the ticker brought transparency, it also amplified market volatility. With information traveling faster, reactions to news, good or bad, became almost instantaneous and often more extreme. Panics could spread more rapidly, as could speculative fevers.
The ticker didn't create economic bubbles or crashes, but it certainly accelerated their dynamics, condensing periods of boom and bust into shorter, more intense cycles. It exposed the market's inherent herd mentality, demonstrating how quickly sentiment could shift when data was universally, instantly available. Despite its revolutionary nature, the ticker tape didn't completely level the playing field. Access to a ticker was still costly, effectively excluding the poorest investors. Furthermore, powerful players continued to exploit subtle delays or insider knowledge. News services, for example, often had a fractional head start in getting information to their tickers, giving their subscribers a slight edge. The ticker democratized information to an extent, but the quest for even faster, more exclusive data would continue to drive financial innovation for decades to come.
Beyond its functional utility, the ticker tape machine became a powerful symbol of progress, modernity, and the bustling energy of American enterprise. Owning a ticker was a status symbol, signifying participation in the fast-paced world of finance. Its distinctive sound and endless stream of data represented the relentless pursuit of wealth and the promise of economic opportunity. For many, it embodied the very spirit of the Gilded Age, a mechanical oracle spitting out the future one stock quote at a time, captivating the nation's imagination. Throughout the late 19th and early 20th centuries, the ticker tape remained the undisputed king of financial information delivery. It was the backbone of market operations through several economic booms and busts, including the Roaring '20s. Journalists quoted the tape as the ultimate authority, and its images became iconic in popular culture, symbolizing Wall Street itself. For half a century, it was the indispensable tool that kept the gears of American finance turning, constantly feeding the beast of capital with fresh data. But like all technologies, the ticker tape's reign eventually came to an end. By the 1960s, more advanced electronic systems began to emerge, first with screen-based displays, then fully computerized terminals. These new technologies could deliver far more data, faster and more efficiently than the mechanical ticker. The familiar clicking sound faded from brokerage offices, replaced by the silent glow of computer monitors. The physical tape itself became obsolete, a relic of a bygone era, as information transformed from a tangible strip of paper to invisible digital signals. Yet the legacy of the ticker tape is undeniable. It was the crucial bridge between manual, slow information exchange and the lightning-fast electronic markets of today. It established the fundamental principle that speed and accuracy of information are paramount in finance. Every modern trading algorithm, every real-time data feed, every instantaneous transaction owes a debt to that humble machine. The ticker proved that the efficiency of capital markets is directly tied to the efficiency of its information infrastructure, a truth that still holds today. So the next time you see stock prices flash across your screen, remember the rhythmic click of the ticker tape. It wasn't just a machine, it was a revolution. It took Wall Street from the age of messengers to the cusp of the information age, demonstrating that in finance, information isn't just power, it's the very foundation upon which fortunes are built, markets are forged, and economic history is written. The ticker tape taught us that the faster money moves, the faster the world changes, and that, my friends, is a truth as constant as the market itself.